How's it going, friends and family? Welcome to another episode of the Compounder's Corner. In this video, we'll be going over the companies reporting their earnings this week, the stock market in general, and businesses that are on my radar. If you can't tell by my voice, got like 3 hours of sleep last night. I'm a first-time dad. I'm a stay-at-home dad, so it's been a little difficult, adjustment period, but it is what it is. And in case you missed it, some videos that were recently uploaded onto the channel. I uploaded 2 episodes of the Public Portfolio Cheese series. The first one talk about 3 stocks that I sold, and in the second video, talk about the 2 stocks that I bought. And I also talk about the case for dividend growth investing. And another video that I uploaded this week, I assessed and evaluated 18 stocks that recently raised their dividend payouts. There's a handful of pretty good ones in that video, so go ahead and give it a watch if you haven't already. So taking a look at your screen right now, what do we have going on this week? And to address the elephant in the room, yes, just like you, my portfolio's in pain right now. I've essentially lost all of my paper gains with some of my core holdings this year, but the last thing that I plan to do is to panic sell right now. And I'll circle back to that here in a bit. Let's see. I guess on a high level, these are the ones that are the biggest market capitalizations. I think the first call out would be Paychecks. It's one of the lesser known payroll companies. The big one that everyone knows is ADP and maybe Paylocity, but Paychecks, I guess that's their ticker symbol name, they focus on small businesses. So that's what differentiates them from ADP. If you're an S&P 500 company, you are not going to have Paychecks do your payroll system. No, you're going to do it with ADP. And about a month and a half ago, I did a dedicated deep dive on my own. I didn't publish it on YouTube or on Patreon because I was like, whatever. And my conclusion is this. I'm not a fan of their business model, like the payroll, human capital management platforms, because when you think about it, Oracle, Workday, and SAP, they can absolutely implement payroll into their software as a one-stop shop. So if you're a business, wouldn't you rather have Oracle or SAP just handle everything under one roof, right? Instead of having multiple applications, multiple software, subscription fees, and whatnot. And this is the bigger reason. Their business model is directly tied to the employment cycle. And if you're following the news, the narrative right now is that we are in an economic downturn and we are in a recession. We just don't know it yet, right? And in the software landscape, I just feel like there's far better opportunities. I will not go anywhere near ADP or Paychecks, okay? Another company that's reporting their earnings this week is Cintas. Now, this is a business operation that tends to hire a lot of military veterans, so I'm familiar with it. So a lot of my colleagues, they would get out as a captain and they pivot right into Cintas and check in or following up on them on LinkedIn. They're still working for Cintas like 10 years later, so I guess it's a pretty good business, right? Or I guess a workplace to be. They basically sell, or I guess you can rent as well, uniforms, cleaning supplies, and first aid kits to restaurants, hospitals, factories, offices, hotels, and more. And on surface level, I know it sounds really boring, but Cintas is one of those boring but stable. It's a quiet compounder that not many people know about. Another one is Fastenal. They're similar to Cintas, but instead of providing janitorial stuff, Fastenal provides stuff like gloves, safety gear, goggles, and everything else inside of factories, manufacturing hubs, facilities. That way, they don't have to go to a Home Depot or a Lowe's or procure it from Amazon or whatnot. Fastenal opens up their shop in a small corner of that factory so that they can go in, kind of like a convenience store, but to pick up more screws, scissors, pliers, whatever it is. So Fastenal and Cintas, I think they're pretty good companies. But if we are truly headed for an economic downturn, probably not. But the reason why I like them is because it's a subscription business for physical workplace needs. So they're not catering for the AI movement. They're not in the business of making drones or anything sexy. But some of these B2B operations that are slow and steady, I don't know. I would take them any day of the week, but they're really, really expensive right now. And I say that because Cintas and Fastenal, they're trading multiples. I think right now it's like a 35, maybe a 40. And if you look left and right in the stock market, dude, Microsoft, I think their forward trading multiple is like a 23. Nvidia is like a 24. So when you think about companies that are posting double-digit growth numbers across the board and their PE ratio is that low, it's hard for me to say that Cintas and Fastenal is a good bargain right now. And so let me circle back to what I was talking about earlier. So realistically, I think this week's gonna move up or down based on the progress of the Middle East conflict. If it escalates further, I'm telling you right now, I'm not a genie in a bottle. I cannot tell the future, but I can almost guarantee that every sector except for oil and the military industrial complex, they're gonna go down further into the red. And based on my understanding, obviously I could be wrong, Iran's using economic warfare to survive their siege from the Israeli and American attacks. Because, let's be honest, pound for pound, they cannot compete in a traditional, conventional warfare format, right? However, they're trying to hurt us in a way where it hurts everybody. Because as they disrupt the global oil supply, it'll pressure the allies like Saudi Arabia, Japan, Germany, to call a stop to the war. Does that make sense? So as it stands right now, the price of an oil barrel, it's surging. And it's making inflation like 10 times worse. Because when you think about it, the cost of everything goes up since the transportation costs just got more expensive. So as oil goes up, so will the price of everything. Now, I don't live in the US, but from what I have seen on the Wall Street Journal and The Economist, is that in certain states and cities, you guys are seeing about $1 increase to your price per gallon. Correct me if I'm wrong, right? I don't know. Here in Japan, we buy gas by the liter and it went up by about 20 cents. So we're feeling it here as well. But I can only imagine that in the US, seeing your gas per gallon go from like 220 up to 320, it's probably not a good feeling, right? But consequently, oil stocks are pumping, right? Because it's creating a supply and demand bottleneck. So whatever oil they do sell, the margins on that thing is going to be fat, right? Because prior to the conflict, I think the price of an oil barrel was like, $55, $62 a share. But now that it's artificially pumped to $110, $120, dude. So that's why the stock markets, they're rotating their money from value stocks like Clorox, Procter & Gamble, Best Buy, and they're rotating it into oil and gas. If you're wondering why the value stocks are going deep into the red as of right now. See, I'm personally not invested into oil, and I kind of wish I did. I mean, as soon as that Venezuela situation happened, I'm not even going to lie to you, I was about to pull the trigger on Chevron and ExxonMobil, but instead, I doubled down on my military stocks. And I do think that was a good call, but in hindsight, I kind of wish I would have diversified a little bit and bought a little bit of Chevron, a little bit of Devon Energy, a little bit of Hess Midstream, but that's neither here or there. But if I did buy into oil, I'll say this right now. If my gains were triple digits at this point, I would look to sell. Because when you look at the RSI and the aggressive rotation into oil, it's not sustainable, right? As soon as this conflict is over, the money's going to jump ship and oil stocks are going to crash pretty hard, going back down to reasonable levels. But I don't see that happening this week because just over the weekend, it's getting worse and worse. And between you and me, I'm not trying to complain, but I'm getting tired of how global conflicts keep spilling into the markets. Like every single time we feel like there's a light at the end of the tunnel, nah, dude, it's just another train coming head on and it's about to collide with us. Because every new headline seems to bring more uncertainty, more volatility, and more stress for Wall Street hedge funds and investors, and amateur and retail investors like you and I. And if you're relying on your portfolio in retirement, dude, I already know this kind of environment probably has your armpits sweaty. And if you're one of the folks that were going to plan on selling stocks to generate a synthetic income in retirement, I think this goes to show you this is a real world example. When your portfolio goes down by 30, 40%, and the pain's not done yet, it's going to go down even further. Will you have what it takes to sell stocks to generate that synthetic income? And that's why I just advocate on this channel dividend investing, right? That way you don't have to sell your principal amount. You don't have to sell your shares. You just keep your portfolio as it is. It'll be in the red as a paper loss, but it'll still generate that income and you can do your retirement. The game plan can just be rolled out as usual. But taking a step back, here's the thing. This entire debacle, the situation that we're going through, it's either a blessing in disguise to buy the dip. Like if you have an active job that's giving you a pretty steady paycheck, it's a blessing, okay? Or it's a very stressful situation if you're 100% invested with zero gunpowder, with zero capital left. If all of your money was 100% into VU or into the QQQ, I mean, right, I feel for you. And that's because the market narrative, if you think about it, it's changed, right? Because leading up to the whole Iran situation or Iran, the markets were pricing in a soft landing. And I'm not going to lie to you, it was about to happen, right? We were about to avoid a recession while keeping inflation in line. And the Federal Reserve were going to cut the interest rates. That's what the markets were pricing in. And that's why the stock market was business as usual prior to things getting out of hand. Because now what the market's pricing in is a prolonged war-driven inflation. And according to the last Jerome Powell speech last week, he said, best case scenario, we might only do one interest rate cut in 2026. More likely than not, because of what's happening right now and the ramifications, I don't think you guys understand. Like Qatar and their gas production supply, it's been set back for a handful of years because it was just blown up. And it's not just Qatar, right? All around the Middle East, gas and oil production facilities are getting disrupted. And that's not going to just allow the supply chain to go back to business as usual as soon as this conflict is over. It's going to have lasting ramifications. And I say that because even during the pandemic, when we saw a car production shortage for about 6 to 9 months, that caused a trickle effect that we're still feeling today, right? Because we had to allocate those chips to other endeavors, companies from Marvell, NVIDIA to AMD. Instead of selling it to the car manufacturers, the higher margins were for the data centers, the AI players, and whatnot. It's the exact same situation right now with SSD and RAM. Instead of selling it to consumers for laptops, computers, and everything else, they're prioritizing the hyperscalers, Meta, Amazon, Google, Microsoft, because there's more money to be found in there. But anyways, because of the car shortage during the pandemic, The used car market right now is absolutely stupid. You can get a brand new Toyota, I don't know, a Toyota Camry for like 28 grand, or you could get a used Toyota Camry with 150,000 miles for like 21 grand. It makes zero sense, right? And so when I think about the ramifications of the oil shortage and the supply getting ruined as we know it right now, guys, we're going to be in pain for quite a bit. And I'm not the kind of guy to have fear and to speak negativity, to be cynical and to be full of doom and gloom, but that's the reality of economics. The last time this really happened, based on Sergeant Google, he says the 1973 Arab oil embargo. During the Yom Kippur War, the OPEC members cut production and embargoed the US and other nations. And that caused the global oil supply to drop by 7%. And as of right now, based on this article that I read from the Wall Street Journal this morning, it says 20% of the global oil supply as of right now, because of the Strait of Hormuz being, I guess, affected. 20%! Guys, that's going to have lasting consequences. And the thing is, Iran's going to continue to strike oil production facilities all over the Middle East so that it could get the allies to peer pressure the U.S. to stop it. And if they stop it, I guess it could be labeled as a loss. Even though you can flip it around and say, oh, but we just put their nuclear production capabilities back by another 2 decades. Maybe it's a win. But the same result for us investors in the stock market, we're going to continue to see red. Okay? So despite all that, I'm still buying stocks. I'm putting my money into the ones that I truly believe. I'm dollar cost averaging every week. Doesn't matter what macro environments or factors are happening, I'm always buying. That doesn't mean I'm putting 100%, right? Because obviously, as I alluded to in prior episodes, I'm building up a cash position that is vesting as, I don't know, it's like a 3.75% yield in a money market fund because I don't think the bottom is here yet. I know there's people that think the bottom's here. It's not here. We still have more red days ahead. And I want to make sure I go all out when the S&P 500's forward PE hits below an 18 or in a perfect circumstance around a 15. If it hits a 15, yeah, that might be the bottom. If the future trading multiple of the S&P 500 gets less than 14, I'm telling you right now, this is a little bit of a hyperbole, but I might sell my entire closet full of clothes, full of gadgets, to buy as much as I can. Seriously. And at the time of making this video, the forward trading multiple of the S&P 500 right now is a 21. So we're getting close, but we're not there yet. And I also wanted to follow up on BDCs because, as you know, if you're a friend of this channel, I really like BDCs, but I sold out of every single one of them last year in the summertime at their all-time highs because I saw what was coming with the pending quote-unquote interest cuts. I knew that the BDCs were going to get punished. So I sold out of them, I rotated my money out, and then I said I will buy back into BDCs once their valuation gets reset. Because I'll tell you this right now. Prior to, I want to say, September of 2025, if you looked up Main Street Capital, Ares Capital, ticker symbol ARC, they were almost at a 20 to 24% CAGR year over year. But because their share price got slashed beyond belief, that's not the case anymore. So when the stock market is at a very high bull run, the BDCs are best in class, the best CAGR ever. And the best part is their dividend yields are usually like 6 to 12%. But personally, I don't want to hold on to BDCs as the market rotates out of them because then my portfolio valuation, the principal amount, will be down by 40, 50%. Even though the dividend might get cut a little bit, you know what I'm saying? Like that total return prospects for a young guy like me, I don't like it. So when the interest rates are high, they thrive. Okay? So they were initially sold off in anticipation of lower rates, right? Like in a perfect world, that's what we priced in. But with inflation staying sticky due to the oil crisis, when it comes to BDCs, again, this is not financial advice. I cannot tell the future, but the sell-off's going to likely continue because uncertainty remains. And there's no clear light at the end of the tunnel. We don't know what's going to happen. Like, if we knew that the rates were going to get cut, BDCs would fall a little bit more, and then they would reach that valuation valley, right? Where they can bounce back. But that's no longer the case. We don't know when the interest rates are going to get cut. They're in this weird limbo state where I think BDCs are going to continue to trade sideways or even further into the red. Like, I like BDCs, but the bottom has not been reached yet. And so in my opinion, I'm going to be patient and I'm going to wait because I know they're going to get cheaper and cheaper. So I would rather buy them when they reach that valuation reset. And because the interest rates are still around like 3.5% or whatever, they have more room to fall. So hopefully that answers what my stance is on BDCs. I love them, but I don't think they're buy and holds because they do have inherent market cycles. And the high interest rate environment is slowly coming to an end. I mean, obviously right now we're in a limbo state of the interest rates being stuck because of inflation being sticky. You cannot cut the interest rates as inflation is getting worse because that would just cause a catastrophic event for the economy. But anyways, I know some of you tuning into this, you might be down $50,000 or even $500,000 in your portfolio, like paper loss, right? And yeah, the stock market, it's pretty ugly right now. I mean, I'm not even going to sit here and pretend like, oh, it's so amazing. Because going into March, I think like at the end of February, I was in the green by like 18% year to date. So in the span of 8 weeks, 18%. I lost all of it. Now I'm only in the green by 5%. But some of my core holdings like Microsoft, deep in the red. Okay? Same with United Health, deep in the red. So I can sympathize with you. But just look at the facts, look at history, look at what has happened in the stock market for the past 100 years. When I say the stock market, I'm referring to the S&P 500. It's commonly referred to as the market. Whenever the market goes deep into the red like this, time and time again, it bounces back. Especially if you're invested into VU, which is an S&P 500 ETF, or SCHD, or any other high-quality ETFs, you'll be fine. The unfortunate reality is, I know there's a good chunk of folks that treat the stock market like it's a sports gambling app, as if it's a casino. And I know you're panicking right now, contemplating the idea of selling at a 40% loss. And that's why the thing is, I started out in 2019 as a speculative, hype-driven investor. I did not care about the financials. I did not care about fundamentals. All I cared about were, does this stock have momentum? Does it have a narrative that's going to be a tailwind? That's all I cared about, right? But then in the pandemic, I think it was 2020 or 2021, during the meme stock frenzy, dude, I lost so much money that I vowed that day I would never, ever invest into speculative crap ever again. If you're not free cash flow positive, if your net income and your bottom line's not increasing year over year and your balance sheet is not a fortress and your dividend profile is not spectacular, I'm not going near you. Seriously, I stand on that hill. But I know if you're invested into unprofitable speculative stocks that have a lot of hype, or I guess now they don't, and you're deep in the red, like that's a different story, man. Right? Like if you're invested into VU, VTI, SCHD, and you're deep in the red, you're going to be fine. But if you're invested into speculative crap, dude, like I'm not even trying to be mean here, but you might be learning the same lesson that I learned back in 2020. I think it was 2021. But I'm really glad that I learned that lesson because it made me put on my head straight. And I started investing with I guess like a Warren Buffett mentality instead of like this gambling casino 10x or nothing options mentality. I feel like, yeah, you might get it right once or twice, but once you lose everything, bro, it's a terrible feeling, right? Despite having that big of a setback, I changed my game plan, my strategy, and my investing philosophy, and I started doing the right things. And then lo and behold, my CAGR for the past 7 years is now about 20%. Well, I guess now because of the freaking crazy situations happening in 2026, I bet now my CAGR is probably down to like 19%, but still, it's market beating. But if I didn't experience losing so much money from investing into hype that did not have solid financials, like their P&L looked like crap, their free cash flow, like if I did not mess around doing that, I guarantee you my CAGR would have been much higher. But I think it's a good lesson because that taught me that my risk tolerance is not as high as I once believed, right? So me personally, even though I'm in the red with quite a lot of positions, I'm not telling anyone else what to do, right? This is just what I'm going to do. I'm going to continue to just hold on. And I'm going to dollar cost average into my highest conviction picks. If you don't know what I'm talking about, I literally have a series on this channel where I disclose my holdings, my positions, my thought process behind why. So go and watch those videos, right? So I'm going to be treating this chapter of 2026 as another lesson in patience. I think in 2021, I definitely would have panicked and I definitely would have sold at a loss. Yeah, it's crazy to see the change and transformation in me because I first started out getting into the stock market by listening to the Berkshire Hathaway annual meetings with Warren Buffett, Charlie Munger. So I started out doing the right stuff in 2019 and 2020, but then once I started seeing those meme stocks like BlackBerry, GameStop, and everything else explode in valuation, I went against my value system and my investing philosophy, and then I lost a crap ton of money. And, it sucks, but because here's the thing. Why patience? When I think about my positions in 2020 or whatever, leading up to the meme stock frenzy, the reason why is because I lacked patience. I saw my positions in Berkshire Hathaway, into Apple, into a lot of these blue chip household names. And of course, like VTI. And I saw that I was only making like 10%, 12% gains. In comparison, I saw these meme stocks flying 100% in a single week. But anyways, those stocks, even though they went on a sell-off and even though they weren't performing as well as the meme stocks, if you were to pause this video and open up Berkshire Hathaway or Apple or even Texas Roadhouse, these are all companies I invested into way back then. Even though they went on that sell-off during the pandemic, they all recovered and they rallied to new all-time highs. And it's more sustainable than hype, than speculative, narrative-driven stocks. Because they go to the moon and then they sell off so quickly that you'll be left holding the bags, right? And that's what I learned the hard way. And that's why I'm saying this is another lesson in patience. Because just like how I looked back in time, 2019, 2020, 2021, if I were to fast forward 5 years from today, 2031, I am almost certain that my positions in Microsoft, Amazon, Progressive, S&P Global, they're all going to be higher than they are today. That's why would I sell them right now? Like, that makes no sense, right? So as crazy as it might sound, I'm going to stay true to my investing philosophy instead of changing course, instead of panicking, and instead of letting emotions to drive my decision making. In life, whenever you allow your emotions to get in the way, that's when you start making stupid decisions like road rage, cussing at your loved ones, breaking things, throwing things. Whenever you allow emotions to get in your head, that's when you start acting in a way that's not of a true man, right? As a true man, you should also be able to tolerate some volatility, to be able to withstand a little bit of a storm, to stay calm, to stay chill, to be patient. For some of us, the best thing to do is to uninstall your brokerage app from your phone, especially if you're checking it every single day and seeing it bleed red. Because that's what I did in early 2021 when I noticed that my gains weren't as good as the meme stocks. And I was like, screw it. I sold out of all of it and I rotated it into meme stocks. And then, man, I got burned bad, right? So I'm telling you right now, if you're doing that right now in 2026 and you're checking your stocks go further into the red every single day, it's not going to do your blood pressure any good. You ain't going to be able to sleep at night. Because I'm telling you, I know some of you watching this video, your portfolio valuation is probably what? 1 million, 10 million, 50 million? I mean, we had a portfolio roast on this channel where his, I guess with his Roth IRA and individual taxable brokerage accounts all combined, it was like 75 million. I know there's whales that watch this content. And if you see your paper loss be negative, I don't know, 20 million, negative 700 grand, I know it's a crappy feeling. But you really got to ask yourself that question. Do we really think Microsoft's going to go belly up? Do we really think it's all over, guys? Amazon is going to go bankrupt. It's it. This is it. It's time to panic sell. No, I don't think that, right? Every single time people say, oh, this time it's different. No, this time it's going to be different. It's like, dude, that's what they said for the past 100 years for every single market correction, depression, sell-off. That's what they always say. We're never gonna bounce back. This is the end of everything that we know. And honestly, I think seeing this is not my first rodeo, right? As soon as I started investing, the freaking pandemic sell-off happened. And I saw my portfolio go 45% into the red. Was it like March 2020 or something like that? And I was like, holy moly, this is not my first rodeo, right? I've experienced this multiple times to the point where I'm like, okay, this reinforces my game plan to focus on dividend growth investing for the long run. Because it doesn't matter if the markets are green or red, that passive income will keep coming in. And no, it's not going to 10x my initial investment or whatever overnight, but I'm done trying to play that game, right? In 2021, that was it. I experienced it, the highs and the absolute lows. I don't want to do that anymore. I would rather go with the slow and steady. To be honest with you, I would even be happy with a 15% CAGR by putting all my money into VU. But by doing individual stocks, by picking and choosing individual businesses, it helps my CAGR to slightly be better at 20%. I would take that any day of the week over 100xing my money versus losing everything, nothing in between. Like, I don't know how people be doing options and like, how do you go to sleep at night knowing that you could lose everything? Especially people that do, have you ever thought about getting margin called? The people that are making risky bets on margin, taking out loans, like, bro, we are definitely not on the same brain wavelength, and this channel is most likely not going to resonate with you. Because I know there's other channels out there that's all about day trading. That's all about pumping money into short squeeze potentials. Like that, I have no interest or desire to consume or contemplate or entertain. That stuff is just way too risky. But anyways, Like I alluded to earlier, I just uploaded a video that argues for why dividend investing makes sense. Even if you're as young as me, I'm 35 by the way, you should watch that video if you made it to this point. And I know this earnings week video that you're watching right now, it's a little different than usual, but up on the Patreon, I'll also write up a post of the stocks that I'm going to be buying right now and at what price. Because I'm going to continue to dollar cost average, because we don't know when the bottom's going to hit and when the rebound's going to happen. Because when the rebound happens, it happens pretty quickly, right? Just like we noticed with the software stocks, they were selling off continuously. And then one day, the stock market realized, well, hold on. They were punished way too harshly. Now let's rotate our money back into it. But now they're also selling off because their constituents of ETFs like VU, VTI, and those positions are getting sold off by hedge funds and people with a lot of money. So that's why they're going back into the red. But just like that event, right? When the recovery happens, it happens so quickly, you don't know, right? So that's why I'm going to continue dollar cost averaging. So if you're curious, go check out the Patreon. I would really appreciate your support on Patreon. Seriously. If not, I mean, it's all good. And yeah, I hope you have a good rest of your week. Good luck and stay safe. I'll talk to you guys next time.